Hello, welcome back to this week's market update. Today is Monday, July 13th, 2026, and we'll jump right in. Looking at last week's market performance, growth and tech stocks led the market higher as investors rotated away from value stocks. Economic data was relatively light, with the market's attention shifting towards the start of the second quarter earnings season this week. The Nasdaq Composite led the week with a 1.7% gain, followed by the S&P 500, which was up 1.2, and the Dow, which fell 0.5% last week. Moving into our economic data from the week, it was a bit of a lighter week. However, we did get some really good data on the housing market as well as the labor market. So, looking at our existing home sales from the month of June, they declined 2.4% in the month, but were up 2.8% from a year ago, reflecting continued stability in housing demand. Inventory fell 0.06% in the month, but was 1.3% higher than a year ago, leaving the supply of existing home sales essentially unchanged at 4.6 months worth, the same as June of 2025, up slightly from May's number there. Last but not least, the median existing home price increased 1.8% from a year ago to a record high of $440,600, continuing its gradual upward trend at a pace below the historical average rate of home price appreciation. Even with existing home prices reaching an all-time high last month, affordability has gradually improved as wage growth has outpaced home price appreciation in recent years. Over the past 3 years, from July of 2023 till last month end, wages have been up 11.7%, while the median sales price of an existing home was up just 7.4%. This represents a notable reversal from the prior housing boom, when from 2020 to 2023, the median home price surged 34.2%, while wages were up just 14.5%, with housing inflation more than doubling wage growth. Even with this recent improvement in housing affordability as wages have outpaced home price growth, elevated mortgage rates continue to limit affordability and remain a big challenge for prospective home buyers. Shifting gears into some labor market data, initial jobless claims for the week ending July 4th totaled just 215,000, down 2,000 from the prior week. The 4-week moving average fell similarly, falling more than 3,000 to a 218,750 level. Claims have continued to remain in a healthy range. You can see really range bound by this 260 to 180,000 claims since late 2021, continuing to signal a stable labor market and serving as a positive indicator of the economy. Alongside the initial claims report, we also got continuing jobless claims for the week ending June 27th, totaling 1.814 million, increasing slightly from the prior week, but still well below this level of 1.9 million in the fall of 2025. Similar to initial claims, the longer-term trend has remained fairly stable, with continuing claims holding below this 2 million level really since the end of 2021 as well, reinforcing the view that the labor market is solid despite slower hiring activity. Last but not least, second quarter earnings season begins this week, with expectations running unusually high after analysts have revised earnings estimates upward throughout the quarter. Consensus forecasts call for more than 23% year-over-year earnings growth in the S&P 500 on about 12.2% expected revenue growth, with 10 out of 11 sectors expected to post positive EPS growth. The reporting season begins with a heavy focus on the financial sector, with JP Morgan, Bank of America, Goldman Sachs, Wells, and Citi all reporting tomorrow. Then we shift to some technology earnings, J&J, some more financials in Morgan Stanley, BlackRock, and Progressive. Then to cap off the week, we'll get some more tech earnings from Taiwan Semi, some healthcare sector earnings from United Health, GE Aerospace, Netflix, and Abbott Laboratories. So it will be a big week ahead. And in the upcoming 2 to 3 weeks, it will continue to be full steam in earnings as the big tech names begin to report as well following the financials. So that concludes this week's market update. We really appreciate you tuning in, and we look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.